Right now, millions of Canadians are going about their day completely unaware that the retirement system they've been counting on their entire working lives is quietly shifting underneath them. And I'm not talking about some distant, maybe someday kind of change. I'm talking about rule changes already locked in, contribution rates already moving, and a pension math that is starting to look very different from what your parents experienced. If you have a paycheck, if you're self-employed, if you're anywhere between 18 and 70 years old and living in Canada. What I'm about to share with you could change how you think about every single dollar being deducted from your pay right now. Welcome to Credit Smart Canada. I'm glad you're here because this is the kind of conversation most financial channels gloss over, and most Canadians never have until it's too late. Let's talk about CPP, the Canada Pension Plan. And let's talk about what is actually happening to it, what it means for your wallet today, and what it could mean for your retirement tomorrow. Here's where the tension begins. The CPP was never designed to be your only retirement income. The government was always clear on that. It was meant to replace roughly 25% of your pre-retirement earnings, a base, a foundation, not a full house. But here's what nobody warned enough people about. Canada's population is aging at a pace we've never seen before. Right now, there are roughly 4 working-age Canadians for every retiree drawing benefits. By 2035, that number drops closer to 2. 2 workers holding up 1 retiree. That's not a scare tactic. That's Statistics Canada's own projection. And when that ratio drops, the pressure on the system doesn't just double. It compounds. So Ottawa did something about it. Starting back in 2019, the federal government launched what's called the CPP Enhancement, a 2-phase expansion of the Canada Pension Plan that is still actively rolling out right now. And this is where a lot of Canadians check out because they hear enhancement and assume it's good news across the board. It's more complicated than that. Phase 1 of the enhancement ran from 2019 to 2023. During that window, both employees and employers saw their contribution rates gradually climb. Before enhancement, the employee contribution rate sat at 4.95% on earnings between the basic exemption and the year's maximum pensionable earnings, the YMPE. By the end of Phase 1, that rate moved to 5.95%. That's a full percentage point increase. Sounds small. On a salary of $65,000, that's an extra $650 per year coming off your take-home pay. Your employer matches that. So the total cost of employing you went up by the same amount. For small business owners and the self-employed, and this is the part that stings, you're paying both sides. You're the employee and the employer. That's $300 a year more leaving your pocket before you pay yourself a single dollar. Now we're in Phase 2. And this is the part that is less talked about. A second earnings ceiling, called the Year's Additional Maximum Pensionable Earnings, or YAMPE, was introduced in 2024 and is ramping up through 2025 and beyond. This second ceiling sits above the regular YMPE and creates an entirely new contribution bracket for higher earners. If your income reaches or exceeds that upper limit, you're now contributing to CPP on a larger slice of your earnings than ever before in Canadian history. The contribution rate on this second bracket is 4%, but it's 4% on dollars that were never touched by CPP before. For someone earning $80,000 or more, this is real money. Not theoretical money, real out of your paycheck every 2 weeks money. And here's the question Credit Smart Canada wants you sitting with right now. Are you getting more back for what you're putting in? The honest answer is, it depends on when you retire, how long you live, and how these projections hold up over the next 3 decades. The enhanced CPP promises higher eventual benefits for those who contributed more under the new rules. If you're in your 20s or 30s today, you are the generation that will contribute the most under enhancement and theoretically receive the highest CPP benefit in Canadian history when you retire. The math looks decent on paper, but it assumes the fund performs as projected, that inflation doesn't erode those future benefits into something less meaningful, and that you actually live long enough to collect in full. For Canadians in their 50s right now, the people who contributed for decades under the old lower rates and are approaching retirement, the enhancement does very little for you. You missed the main contribution window. Your benefit calculation is based largely on what you put in before enhancement. You're contributing at the higher rate for only a few years on the back end. The boost to your monthly check will be modest. And yet your take-home pay is lower today because of those higher contribution rates. That's a real trade-off that nobody is putting on a billboard. There is also a generational conversation happening beneath all of this that Canadians need to start having openly. The CPP Investment Board, the CPPIB, manages the fund and has, by most measures, done an impressive job. As of recent reporting, the fund holds over $600 billion in assets and has posted strong long-term returns. On paper, CPP is one of the better-funded public pension plans in the world, but strong fund management does not change the demographic math. More retirees, fewer contributors, longer lifespans, and growing benefit payouts are structural pressures that no investment return can fully absorb forever. The enhanced contributions buy time. They shore up the foundation. But calling it a complete solution would be dishonest. What should you actually do with all of this? A few things. First, check your CPP statement of contributions. You can pull this through my Service Canada account online, and it will show you every year of earnings and contributions on record. Errors on that statement, missed years, wrong figures, can reduce your eventual benefit. Catching them now matters. Second, use the CPP retirement calculator on the government's website with realistic numbers, not best-case assumptions. Run the numbers at age 60, 65, and 70 so you actually see the trade-off of taking it early versus deferring. Third, if you're self-employed, talk to your accountant about how the second phase contributions are hitting your net income, because the deduction structure for CPP contributions has changed, and there may be planning moves worth knowing about. And finally, the most important thing I can tell you, do not let CPP be the whole plan. It was never meant to be. Whether it's a TFSA, an RRSP, a company pension, or even just building equity, the Canadians who are going to feel the least stress in retirement are the ones who treated CPP as one layer of a stack, not the entire foundation. This is exactly the kind of stuff we break down every week here at Credit Smart Canada. Real Canadian financial topics explained without the jargon, without the fluff, and without pretending things are simpler than they are. If this video helped you think about your own retirement picture differently, hit that like button because it helps more Canadians find this channel when they need it most. Subscribe if you haven't yet, because we've got more coming on OAS clawbacks, RRSP deadlines, and the quiet ways Canadians are losing money they didn't even know they had. Drop your question in the comments. Seriously. What do you want to know about CPP that nobody's explained clearly yet? I read everyone. See you in the next one.